Hi everyone, very good evening. My name is Anuj and I take care of our channel partner trainings. And I welcome you all to this session on Vivriti Diversified Bond Fund AIF. Mr. Soumendra, CIO, Chief Investment Officer from Vivriti was supposed to come today, but due to a medical emergency is not here with us. So in place of Mr. Soumendra, we have with us Mr. Naveen Ashok, who's taking care of, who's the sales head basically for Vivriti. So he'll be starting the session and he'll be taking the session. So first go through the session first, and then if you have any questions, any doubts, you can come up with your questions. So over to you, Mr. Naveen, when you can
So,
start your presentation.
Naveen, before we start, let me also set the context here that,
Sure.
we have partners as well as some of their clients as well on the call.
Yes, sir.
So we have partners as well as, so advisors as well as their investors. Let's put it this way, right?
Okay.
And number two, let me just also call out a few questions or queries, or rather doubts that, or, that every advisor or their clients have, that, one, why Vivriti, right? They may or may not have heard about Vivriti. Number two, why a debt AIF when they can do mutual funds, debt mutual funds, or they can do bonds and NCDs directly? Then why should they look at debt AIF as a category at all? And number three, what are the risks and pitfalls associated with such an asset class as well as product class, and how Vivriti is trying to address that? So these are the three main questions that we should definitely, during the course of our presentation and talk, address it. And then, obviously we'll open the floor for Q&A, and our partners and, their clients can feel free to ask whatever doubts and clarifications that they have.
Sure. Thank you, Anuj and Anirudh. So what I'll do, I'll just let you know the flow of the conversation. So what I'll do, I'll just try to give you an overview of what Vivriti is. I think most of you might not be heard about the group. So let me try to give you an overview of what Vivriti is all about, and then we can talk about the space that we are operating into, and then eventually we'll talk about the fund that we are discussing today. So what I'll do, I'll just beam up my screen. Just let me know if you can see the screen. And please feel free to stop me. And if you're having any doubts in between, please feel to stop me, and we can address those questions there in there itself. Although we'll be having a Q&A session at the end of this conversation also, but if you feel that I should be stopped and you need an explanation, please feel. I hope you can see my screen.
Yes, Naveen.
Sure. So, Vivriti, we have started in year 2016-17. So we are running in year 7-8 years of being operational. So Vivriti comprises of two companies as of now, Vivriti Capital and Vivriti Asset Management. So Vivriti Capital is a holding company of the group, and Vivriti Asset Management is the company that I represent. So to give a brief intro about myself, I take care of the central relationship for Center City, and also I take care of the entire northern part of India. So there are different teams which handles north, south, west, and east. So I predominantly take care of the northern part. There will be separate teams reaching out to you wherever you are based out across India. So we have divided India into 4 parts. So accordingly, each and every part is headed by one person. So coming back to the presentation, Vivriti Asset Management is the company that I represent, and Vivriti as a whole operate into a segment what we call as a mid-market. Mid-market for us is on a rating spectrum, if you see, starts from a rating of A minus and below, and go up all the way upward to triple B minus. We usually don't invest into segment right unrated or startups. If you talk about the revenue of the companies that we usually look after, we look after companies with a revenue size of more than 100 crores and above. So the companies are fairly matured. The companies have a top line. Company have business model. So there is no business model risk involved in the companies that we usually look after. And we usually like companies where they have a banking line, where the promoter is stable, where the shareholders are there, and we don't see any governance risk in those kind of companies. So these are the companies that we want to fund. So on an financial basis, if a company has a revenue of more than 100 crores, is where we look after and then try to invest into those companies. On the equity side, we have been funded by three private equity players: Creation, which is a US-based private equity firm; LGT, again from Europe; and TVS Capital, I'm sure you might be aware of, based out of South. So we, in total, these three entities have put in around 1,500 crores into Vivriti and Vivriti Asset Management. So Vivriti Asset Management and Vivriti Capital combined, we have lended out around more than 30,000 crores in total. As far as AM is concerned, we roughly manage around 10,000 crores, out of which two-third will sit at Vivriti Capital and one-third will sit at Vivriti Asset Management. Vivriti Capital is rated by CRISIL as CRISIL A+, so we have been fairly well rated by all the rating agencies. On a number basis, if we talk about Vivriti Asset Management, to be precise, this is our 11th fund. So we have launched 10 fund in last 4 years. On a commitment basis, we manage around 4,200 crores of commitment and roughly 4,000 crores of AUM that we are managing. Uh, we are managing a LP list of around 800 plus LPs. We have invested across 200 plus companies as of now. And since we are operating in a segment where the average rating of these entities are triple B and plus, we have not yet seen any defaults, any delays, any delinquencies coming our way. The average portfolio yield that you will see on the screen is around 14.5 to 15%, and the average duration that we usually like to be in a company is around 2 years. So these are the broad numbers on the Vivriti asset management side. As far as bigger, if we talk about the split of investor category that we have got money from, on a 100 basis, I think 51 would be on the corporate and family offices side, and 49 would be on the HNI side. So there's a huge demand and flow of money that we have received from HNI segment as well. As far as big corporates are concerned, we have got money from seven insurance company, four banks. There are two DFIs and a couple of foreign investors as well, which has invested into our previous funds. One or two names I want to emphasize on. We have got money from SIDBI, which is one of the India's largest alternative investment fund investor. So this is the first time that SIDBI has invested into an AIF from their balance sheet. So they have invested around 500 crores into a separately managed fund for them. And on the international front, we have got money from IFC, which is a World Bank group. So we are managing around 1,000 crores for them. So the kind of names that have invested with us, and the kind of due diligence that they might have done on us is extensive. So this also give you some kind of comfort that we are not a small or early stage asset managers. We are very well capitalized, and most of the bigger players have shown their trust on us. So just to be on that part. I think what I'll try to reshuffle certain slides on the PPT. As I told you, we have launched, this is our 11th fund. So the track record of the earlier 10 fund has been very encouraging. So in the first set of funds where we have already deployed money and the money is coming back to the clients, we were able to overachieve our returns in all the four funds that we have launched since our inception. Some of the funds are even have closed, so we have a closed history also. So we were able to close this fund actively with hurdles meeting the expectation, and in some cases exceeding the acceptation. The average rating of this portfolio again is in the range of triple B. And again, we have not seen any default delays or any negative impact on any of the portfolio that we have managed earlier in the vintage one category that you can see. The vintage two category is the fund in the set of funds that we have launched last year, and we were able to collect around 2,000 crores in those set of funds. And the fund that we'll be discussing today will also be somewhat a continuation or a replica of the funds that we have already launched. So there's certain amount of track record that you can already see in managing these kind of assets. So the Emerging Corporate Bond Fund, which was our flagship fund last year, we ended up collecting around 930 crores in that particular fund. And we are already overachieving hurdles in that particular fund. Again, no delinquencies, nothing as we have seen as of now. Uh, 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 let me give you a brief overview of the team that we are here put up. Since Anirudh have asked me why Vivriti, Vineet is one of the answers for that. So Vineet is our MD and CEO and co-founder also of the Vivriti Group. So he was earlier associated with a company known as IFMR, now known as Northern Arc. So he was the first fund manager in India to launch a debt AIF. So he is one who has the longest track record in managing credit AIFs in India. So you can say that Vineet was the one who started this trend of launching a credit AIF in India, and he is one who understands this segment very well. Vineet is the founder and also the CEO of Vivriti Asset Management and Capital. On the investment side, we have Soumendra. Again, earlier in his earlier avatar, he was associated with Northern Arc, HSBC, and IFC, the World Bank Group. He is one of the co-founder, and he has put in his own money into the company. He's a CIO. He's a conscious keeper of the fund. He decides which are the companies that we can evaluate, which are the sectors that we should be evaluating. Again, Mohammad Irfan, who would be the fund manager of this particular fund. He has been with the company for last 3 years. In his previous avatar, he used to manage a short-term book for Aditya Birla Group. Very well accepted across the sectors. He is one who having around 11 years of experience in managing certain this kind of asset which we have in the portfolio. Uh, on the broader team, we have Raghu, again, very well experienced. He comes with a ICRA background, a rating background. Deepen, who heads product for us, again, from a rating and NBFC background. Then the kind of team that we have in investment, we have people from four categories, usually from banks, NBFCs, a big four, the consulting one, and the mutual funds. So the kind of team that we have built out is very well diversified. We have one of the largest investments team that you can find in any of the AIFs. We are a 20 plus member strong team, investment team. On the credit side, if we put together VAM and Vivriti's Capital's credit team, we would be close to 70 members. So that would be one of the largest credit team that you can find in India. For that matter, if you take the largest mutual fund, also they might have hardly 4 or 5 or 10 max people in their investment team. So the kind of width we have in the investment team and kind of experience and the diversification in terms of their experience is quite vast. This might give you some amount of comfort that once we invest into a company, there's a huge set of team which also be monitoring those company, which is a very important factor if we are considering investment into a credit AIF. Any question so far, team? I'll be jumping through the sector and then the fund eventually. So, as any questions as of now? Any questions on the group? Any questions on the team? Am I audible?
Yes,
Hello?
yes, you are audible, Naveen. I think
Okay,
we don't
okay.
have any questions, so you can go ahead.
Sure. One of the feature of an alternative investment fund is that apart from the fund manager who takes a call that which of the companies which would be forming a part of the portfolio, there's an investment committee which equally holds importance in selecting a company to be part of the portfolio. So Vineet is a part of that committee, and Hemang, who is our group officer, forms the part of that committee. We have an external member here known as Kalpesh Gada. In his earlier avatar, he was head of structured finance rating at ICRA, and currently he holds assignment with Asian Development Bank. So he is an external member. He is not an employee of Vivriti. He holds a veto power into telling us that this company can be and cannot be part of the portfolio. So it's not like it's all Vivriti member who will be deciding the portfolio. There's an external member who holds a equal importance in selecting the portfolio, and a very well dignified member in Kalpesh we have on the board. Uh, one slide I want to show up, and I think that will encompass the entire segment that we are operating into. The graph that you can see in front of me will give you an idea of where we are investing and why we are investing in the sector that we are investing into. If we see the y-axis, the blue part, the additional need of a credit capital is where you will find companies bigger if I can call names to give you some comfort, then Reliance, Adani's of the world would be falling in this bluer bracket where these companies are very well banked, and they get capital market participation very easily, and their end users are also working capital kind of thing. So these are the bluer segment. If same kind of company wanted to have a capital for an end use which is not bankable, for example, like promoter financing, if they want to have a distress financing, that is where we categorize that investment into high grade private credit. This is a segment we are not present into. These are the segment we don't see any value presenting into. What the segment that we are presented into is known as performing credit or mid markets. So, for example, if there is a mid market company which has a banking line, but due to the end use restrictions or due to the turnaround time at the banking end, they're not able to get the money on time. That is where we come into the picture and lend it out to those companies. That doesn't mean these companies are low grade. This company might have a rating lower than the bigger ones in the range of triple B and above, but these are very well capitalized company. These are EBITDA positive company. These are company with track record. These are company with a proven business model. So these are companies where we lend out to. So these are the segments on a graph, if you can put down that mid sector restricted capital basis on their end use. So if it is a working capital loan, or if it is the capital expenditure or project financing, or if it is last mile financing of any of the infrastructure asset that the company is building, that is where we put in our own money into those companies. So the sectors that we'll be avoiding while selecting any of the companies would be we won't be doing any of the startup funding. That is a segment that we are not present. Startup early stage companies which are very early in their journey, which have not yet proven their business model, the profitability is not there, they might or might not have a banking line, other companies that we really don't consider. We don't consider real estate investments, so that is one segment that we don't understand, and those are the segment which are for longer duration. These are the investment that a company will have and ask money for more than 8 years and plus. We are not comfortable to lend out to those companies for such a long duration. And other segment that we don't lend out to is the jazzier stuff, the promoter financing, the takeout financing. If there is any dispute in a family and someone wants to fund that dispute, that is something that we don't do. What we do is pure, simple, boring lending to a company where the end use is very much well defined. It is for growth capital or it is for working capital requirements. That is what we lend out to a company. And we lend it to only bankable companies. That's it. So our subset in India, if you'll say it, there are around 22,000 companies which are rated. Out of that, if I take all these filters, there are around 4,000 companies where we can look into, and out of that 4,000 companies, I have already lent out to around 300 plus companies. So the gap is relatively there. So we are still about to evaluate around 2,000 more companies in this segment. The investment that we usually do from Vivriti's side, we are a very well diversified. We try to look at a very well diversified portfolio approach. As of now, we are covering around 33 sectors at Vivriti. So the concentration would not be very much in one sector itself. So it's a very well diversified portfolio that you will find here. All the deals would be secured. All the deals would be primarily originated by us. We would not be doing any securitization deals in any of the portfolio. We'll not be doing any DCM deals. So the reason for this is we want to be in more control of the covenants that we place for these companies. And as I told you, it's an EBITDA positive investment, and all the investments are rated. We usually don't go for unrated companies. The fund that we would like to discuss here today is known as Vivriti Diversified Bond Fund Strategy 2, Y2. We already had a series 1 last year. It's a 2,000 crore fund. It's a big fund. It's on a gross level. We are targeting a yield of around 15 to 16 here. If we talk about the tenure, it's 5 years from the initial close. Initial close we are planning in Feb end. That would be of 200 to 300 crores. It's a category 2, so taxation would be passed through and it would be in the hands of the investor. The yield or the returns that the client can expect would be in the range of 1275 to 1325 or 1250 to 1350, depending on the amount that you come in with. Uh, and yeah, there would be quarterly cash flows in the range of 10% annualized. So there's a certain amount of cash flows built into the fund. So you'll be getting quarterly cash flows, and by fourth year, you will be getting 50% of your capital back. So it's not like your money would be fixed or invested for the entire 5 years. We like to have duration lesser than 5 years. So it's hovers between 2.5 to 3 years. That is where your money would also come back to you. So a very high level of liquidity into the fund. You will be getting the money by March 29, the entire set, and by March 28, around 50% of your capital would be coming back to you. And obviously, there's a quarterly flow coming back to you every quarter. So I'll like to address three questions that Anirudh had. Why Vivriti? So we are one of the largest player in credit AIF. We manage around 4,200 crores. We are the only AIF, I think I guess, who have launched 10 funds in last 4 years with an impeccable track record. We have not seen any defaults, delays, or anything. We have Vineet on board with us, who is someone who has the longest track record in managing this asset. We have seen cycles right from 2008 to COVID to IIFL to Yes Bank, and we have managed to manage our portfolio well throughout all these events. And the second and the third point would be we operate into a very institutionalized way. So the kind of investment team that we have on board, 20 plus member team and 70 plus member team on the credit side is one of the largest. So this also gave us a dry powder in managing once we invest, so managing and monitoring those assets that we're already invested into. So we might be a new name to many of the other investors, but in credit circles and in the mid market segment, we are a very well respected name. Why we should consider alternative investment as a category. So I'm sure that most of the advisors or clients present on the call will have exposure to equities or to some extent debt mutual funds also. Where I think where we try to differentiate in terms of an AIF is like what we are providing you is a differentiated offering in terms of credit where the risk is very well managed. There is certain amount of liquidity. And the investment manager is someone who has a track record. So if you want to have a diversified portfolio in debt, I think which is not correlated to the market. So once you sit with your client with a portfolio review, you will be rest assured that this one portfolio would be having certain return that you have that we have promised earlier. Which would be close to what we have promised earlier. So there would be no deviation in as such in the returns that we have promised. So that this is one point I want to emphasize on. Anirudh, what was your third question? I'm not able to recollect that.
I think he must be busy. I think there were two questions by Anil, right? First is why Vivriti, and second is why debt AIF, I think, right? So that was I
Huh.
think his main question. Why debt
Yeah,
AIF?
Naveen, sorry, I had to take another call. So yeah,
No.
Yes, yes.
the questions were that, of course, you have already answered Vivriti. Now, second is, that when we are looking at debt AIF as in category, right?
Right.
Then the other competing asset classes or product classes are debt mutual funds. You have corporate bonds, you have NCDs, high yielding NCDs and bonds, etc. And therefore, why should somebody look at debt AIF as an asset class? And third, when we are looking and talking about debt as an asset class, the most important and prime factor in anybody's mind is the risk. Because obviously I'm coming to the debt as an asset class because I don't want to take equity risk, or I want to protect my money. But at the same time, I want to beat FD returns. I want to beat inflation, right? But at what cost and at what risk?
Sure, sure, sure. So I'll divide your first question into two parts. The in debt we usually have two options. One is to directly invest into debt MF, and then second would be to directly have exposure to the instrument which is there available, individual instrument which is there available in the market. So for individual instrument which is there available in the market, there are two disadvantages to that. One would be a very concentrated exposure to that one single entity, and second would be in my opinion that those deals are mass deals. So when a retail investor invest into those deals, he doesn't have any control on the terms and conditions of that particular deal, even though it might be a very big company, where an asset manager evaluate NCD or an MLD, he has much more larger control and much more larger reach toward the management, toward the higher management of that particular company, and the governance for that matter suits to what the fund envisaged to be. So if we have if we have a very stricter governance in terms of, I mean, the restrictions or the rules that we put into an NCD, that if your EBITDA numbers are below this, then you have a put option. If your equity raise is not happening in next 6 months, 3 months down the line, then I can call back my money. Those options are not available for a retail client if they are investing into a single bond issuances. And on top of that, there is no monitoring as such. So there would be no monitoring of those assets. You just invest it and forget it. Whereas when we invest into any entities, there's a quarterly review with that promoter. There's a monthly review if we feel that the company is at high risk. Then accordingly, the monitoring happens very frequently. So if anything has to go bad, we can monitor it well, and we can take proactive actions in that. Whereas that won't be available to a retail client if he is investing into a direct bond. Uh, I hope that answers your question. If we talk about debt AIF, most of the debt AIFs, I'm assuming, apart from the credit, play a duration call, whereas credit AIF are not what credit funds should be. They end up investing into double A and above assets. So we cannot call it a pure credit strategy for that matter. The duration strategy, as we all know, is very much linked or is correlated to what is happening in the market. So if anything is going up, down, your portfolio will always be there would be too much of volatility in your portfolio. So what a debt AIF offers you, if if you're coming in a category to a close-ended strategy, you see a certain amount of stability in your returns, certain amount of stability in your portfolio, and if the risk is very well managed, I think your money definitely will come back to you. That is what we have seen in earlier funds. So a predictability of returns is one very big advantage of coming into a debt AIF, and that is also of category two. As far as taxation is concerned, I think taxation is equal for all of them. So that advantage where MS used to have earlier, that is not there now for any of those. So if the risk is very well managed at the credit AI side, I think the predictability of the returns and the avenues of diversification that it opens up for the client is huge. So for that matter, in our case, the kind of companies that we'll find in my portfolio, those companies will not find anywhere else. Nowhere else. So you might be end up investing if you're doing the debt AI, debt MFs or direct bonds. You will be end up investing into the deals which are widely circulated, bigger names. Maybe the yield might not be that attractive over there. But we don't know the terms and conditions. We don't know if it is principal protected, if it is if there are enough collaterals for that particular deal. In our case, each and every deal is primary source. Each and every deal has around 1.2 to 1.5x of collaterals backing that particular investment. So it's pretty secured in that way. On part of risk, yes, if you're talking about a gross risk in our particular or any of the particular AIS that we are talking about, if you're talking a gross yield of around 15 to 16%, there is certain amount of risk that the client should be aware of. Uh, but what differentiate an asset manager is like how he manages that risk. So in our case, the kind of due diligence and the monitoring that we have put in place have allowed us to mitigate those risks, and the kind of guardrails that we have put at our end when we are evaluating a company minimizes that risk. So each and every investment that we do is in a amorting structure. There's a quarterly flows or a half yearly flows. We try to build into that portfolio. We try to have quarterly reviews, yearly reviews with the management team so that we get to know what is happening in the company, if any corrective action has to be taken from our side, or the client has need any help from our side that we can provide. We can do that since we are connected to much larger capital market audience. So that comfort we try to give it to the client. So in terms of risk, I think at Vivriti, since we are managing around such a large book and we have been doing it so well for last 7, 8 years, I think the risk is very well managed here, and that has to go with the kind of due diligence processes that we have in house. So when we were, so I'll take one example for that matter. So that might give you a context that how we evaluate a company and what are the trades that we usually do. So if we talk about the broader sector, once we have a view on the sector that these are the sectors that we want to invest, we evaluate a company basis the governance, the sector that he is present into, and the financials that the company has. So once that backend is very solid, and we rely to very large extent on the digital footprint that the company throws. So basis all the GST numbers, basis the PF numbers, basis the number available on the free market, we form a view that is it worthwhile to evaluate certain companies. If it is worthwhile, then we usually have a 2 to 3 day visit at companies' premises. We talk to their lenders, we talk to their equity partners. We talk to market participants that what is your view about this company, and then we form a report and then we present it to the investment committee, and then we have a discussion on that. So this entire process takes around 6 months to 3 months to evaluate a company and then finally invest into a company. So to take a one example, in our last fund, we invested into a company a company known as GMR Goa Airport, wherein I think in end December, the airport was inaugurated. But 6 months before that, I think there was a cost overshoot at the company level because the construction was delayed by 3-4 months. So and that airport was handled by a consortium of Axis Bank. So what Axis told the GMR group that if we want to put in more debt, then more equity should also come into the project. That GMR Goa was not very much comfortable of. So what we saw as an opportunity, wherein the construction of the airport was 98% done. Only the signages, the end, what you call the end final finishing of the airport was left, and they required a capital in terms of around 100 to 150 crores. So we evaluated this asset, I think, and we were able to lend out to this asset with to JMR at 15% rate, whereas Axis were lending out to them at 9%. We are sitting in a mezzanine tranche below Axis with an equal pari passu rights on their collaterals, and we have receivables of the non-aero revenue of GMR. So my investment is 100% backed by non-aero revenue receivables from GMR. So these are the kind of deals that we usually evaluate. So GMR you will not find in any of the market deals that you might have evaluated earlier.
So Naveen, if I ask you about the portfolio allocation, so like how many companies are there in the portfolio, and what is the minimum, the maximum exposure that a company has in
So
the portfolio?
a company will not have more than any company will not have more than 5% of exposure. So it would be a 25 plus company kind of portfolio that we are looking here. In my earlier fund itself, I am running a portfolio of around 28 companies as of now. So the diversification would be very high and the concentration would be very low.
Okay, so 5% for per company, you are saying, right?
Yeah. Less than 5%.
Less than
We don't want
5%.
to,
So again,
we will not be breaching the 5% limit.
totally around 25 companies would be there.
25 companies and plus, yeah.
Sure. We have one question in the chat box, but I think you have answered most of the part of it. But still, if you want to take this question, so the question is: are these bonds that you fund would be investing securitized? Question mark. And what risk management measures you have taken to minimize default risk?
So as I told you, all the deals are we are primarily sourcing these deals. None of would be securitized deal. Risk parameters would be there, so it would be backed by collaterals. It would be a combination of receivables, liquid collaterals or hard collaterals, wherever we feel that hard collateral is necessary. Although we like to be on the liquid collateral side, those are the assets which are more liquid to sell when anything is going bad. So we would be having 1.2 to 1.5x of collaterals for any of the deals that we do, and these are all primary deals. Senior primary deals, yeah. Any more questions, team?
So guys, if you have any more question, you can ask to Mr. Naveen. And even our partners, investors, our Centricity team, if you have any question on this Vivriti bond fund, you can ask it. So Naveen, just a simple question from my side. I mean, I think maybe you have answered this in your presentation. So as an investor, if I invest, so like what would be my returns post fees? Maybe a 12.5%.
Yeah.
Approximate.
So if you are coming with a 1 crore check, maybe so your returns would be in the range of 1250 to 1325. So on an average, 13ish is what you can expect.
Around 13%.
Yeah,
okay.
And that also
Post
cash
fees.
flow. Post fees, yes, post everything,
fees.
yeah. And there would be a tax on that.
Yes, yes, absolutely.
So there would
So
be a
again, this is
TDS whenever there is a quarterly flow of 10%. Yeah, and that would be mapped to your
600 to
balance.
700 bips higher than a debt diversified portfolio, you can say, mutual fund
Yes,
portfolio.
yes. That is our endeavor that we
Right,
should be
right.
delivering around 500 bips more than what the debt AIFs are, that MS are doing.
Right. So if an investor, understand risks, he understand that yes, how it works. So if he understands all the things, so I think he can invest, he can consider this particular strategy, particular fund. I think.
Definitely.
Absolutely. Anil sir, any further questions? If you have anyone else, if you are having any question, you can ask.
One more point that I want to put in. So by regulation, the minimum investment into any AIFs is around 1 CR. So, but there's an accredited investor arrangement that the government has. So if any of the investors in an accredited investor, they can have an investment into our AIF with a minimum ticket size of around 25 lakhs also. So yeah, so if you want to test the fund with a smaller amount, you can do that as well with the 25 lakhs, and then you can top up as and when you require.
Sure. Right. Anirudh sir, any closing remarks?
I think
Before
we are
we
good.
end this session.
So for all the partners and investors here, debt AIF is definitely a very fast growing category as a product category, as well as it's a very good as well as important asset allocation tool, because we have all seen that when markets are doing well, there's a general tendency among the investors and sometimes even advisors that we get swayed and carried away and we start allocating more and more towards equity. But it's important to have that balance and to have the asset allocation in place, and debt as an asset class, and within debt AIF as a product class is a very fast growing and evolving category, which everyone should look at from the risk versus return point of view. So that's my only submission. It's a very important and good tool to have in the portfolio and in your arsenal to take it to your clients. I think Naveen, you have answered most of the questions very well. So if there are further doubts, or if our team or their partners want to do any further calls with Vivriti, we would definitely reach out to you and arrange for the same.
Sure.
Thank
Thank you
you.
so much, Anurag-ji. So we will be
Thank
more than happy to assist you in any of the clients call that you might want us to be part of. So all time available. Any VCs are required, any in-person meetings are required, then we're more than happy to come on call. And if you feel that any of the other investors where my CIO is required or my fund manager is required or any of the other senior members are required, please feel free to reach out to us.
Great. That will be really
Absolutely.
helpful.
Yeah.
Thank you so much, Naveen.
Thank you so much, team. Thank you.
Thank you, Naveen ji, for your beautiful session today. Thank you so much. And I want to thank to our partners for joining in today, and Centricity team and the investors. So thank you guys. Thank you so much. Thank you, Naveen ji. Bye.
Yeah. Thank you. Happy weekend.